Well, folks, welcome into the rarest of the rare. We got a 4-piece here today, 4 videos for me to react to, give my opinions and perspectives on. First one up here, markets will rally when Federal Reserve announces end of rate hike, says Tom Lee. So we're going to hear what Tom Lee has to say. Always interested to hear his viewpoints, okay? Then I want to react to this one. The market is prematurely pricing in rate cuts. And so I want to hear from these folks, kind of give my opinions, perspectives in regards to that one. And then we got SoFi's Liz Young on August inflation data, basically saying consumers are screwed. And I want to hear what she has to say, kind of give my opinions and perspectives. Woo! And then for the 4-piece, the last one, okay? The bear case for oil is the economy is in a serious recession. I think that's a very important subject. It's important. It's a subject I talk about a lot. You always hear these bears talk about, they think things are going to be bad, but then they think oil price is going to be very high, and I think there's going to be some struggles with that, okay? So appreciate everybody joining me as always. Thanks so much for being here, folks. New all-time high subscribers in the History Channel. Appreciate y'all being here as always, and even for a 4-piece like this one here today. Also, pin comment down there if you want to apply to join my private group. You can go ahead and fill out an application down there. We'll see if you're a good fit to join us in there. Alrighty, let's get into this.
Advisor's managing partner, Tom Lee. Tom, it doesn't feel like that's where we're headed. Even if they are done raising rates, they're not going to signal that next week, are they?
Sarah, next week would be a tall order for the Fed to be that confident. I do think by November they're going to have enough data points to feel that way. But it is, I think, what we saw with the ECB and how markets reacted, a pretty big deal that once a central bank feels that they've reached a point where the data is sufficient for them to sort of reach their last hike, it's going to take a lot of uncertainty out of the bond market. We saw that yesterday across all the regions in Europe and all the term structures of Europe, and that would trigger a risk rally. And it's very akin to 1982. I think there's a lot of folks here who think once the Fed says they're done, they think the stock market actually continues to go down, but I think it's the opposite reaction is going to take place.
But a lot of people that I talk to think that...
Yeah, so if you want to know typically how this is going to work, if the market's going to go up or down or all around or those sorts of things, usually actually when the Fed starts cutting rates, that's when the market usually starts going down. The great example of that was prior to the great financial crisis. When they stopped raising rates, the market didn't start going down. It was when they started cutting rates that all of a sudden the stock market started to tank in a significant way. And by the time they got down to 0% rates on Fed funds rate, the market had basically crashed at that given moment. So yeah, that's something to kind of keep in mind here. It's not the end of the world if they stop raising rates. If they start cutting rates, that could be, it's not a guarantee, but it could be a potential worrisome thing because usually the Fed won't cut until they see real problems starting to emerge in the economy. And that's when things could start getting really, really scary in regards to that and where the market could start getting really freaked out.
It's the wrong reaction because it's not as if when the Fed stops raising rates, they're going to start cutting rates. It's not a reversal of the liquidity environment. Instead, they're still doing QT. So they're still trimming the balance sheet, and they still plan to keep rates at this high restrictive level for a long time.
Yes. But I think investors who have that view are anchoring around a business cycle concept of Fed.
Right, before he goes here, what does Tom Lee expect? When the Fed says it's done hiking, long-term yields likely fall. Okay, interesting. Interest rates adjust. How much are they really going to adjust? So 30-year mortgage rates decline by 150 basis points. So basically that's 1.5%. So that would be taking mortgages from 7% plus, which is where they're at right now, to about 5.5%. So, interesting. Yeah, that would be a pretty big move there.
Cycles. We know the Fed is fighting a very different war today. They're fighting a war on inflation, and the restrictive rate they're targeting is a real rate that helps contain and prevent inflation from flaring up. That if they keep rates here, at 5.5%, and then year-over-year inflation next year drops to 2.5, which one can model it pretty easily, that's a huge increase in restriction, probably enough to put us in a recession. So I think the Fed would be in a position to actually cut, only to keep real rates constant. I think they want to keep higher for longer real rates. They don't want to increase real rates. And the effect on the mortgage market would be pretty dramatic as well. You referenced it earlier. The excess spread today on a 30-year mortgage to the 10-year is close to 300 basis points. historically, that number is somewhere between 1.5 to 1.7 percentage points.
Interesting.
Meaning even if 10-year stays flat and the Fed signals an end, mortgage rates could drop, 1.5%.
Yeah, there have been some jokes this week about what would happen if mortgage rates got above high yield, which that's ever happened. It'd be amazing if it did. I do wonder, Tom, price action wise on some of the AI names, reaction to NVIDIA's quarter wasn't stellar. You could say the same thing about Oracle. Adobe's down 4 today. Is that just a function of being tired about the story?
Carl, it could be. I think we're definitely seeing a pretty sizable correction in AI-related names because that was the only game in town for most of the year. But we also are in a period of, I think, rough markets. Since August, it's really been a game of inches. I don't know if people want to have that much risk in August and September. I do think once the market, again, reattains its sort of uptrend and risk-on mode, I do think the AI names are going to be places people come back to because there's real growth there. But I'm not surprised. This is kind of a risk-off environment at the moment.
Yeah, and another thing that could transpire when it comes to stocks, specifically kind of, let's call it toward the end of the year, and this is important, everybody understands this, is you could have let's call it a chase for returns at the very end of the year. A lot of fund managers obviously let's just call it underinvested going into this year. They didn't really capture much of that huge rally in the first half of the year. And so a lot of them are probably pretty significantly let's call it underperforming the market right now. And when I say the market, I'm really talking about the S&P 500, which is their benchmark. So there is a potential that these folks could rally into the market because they need to make money, right? So like I always say, there's two ways of these fund managers getting back around S&P. One is they invest heavily and kind of chase returns at the end of the year. The other is the market falls quite a bit and the market comes back in line with, kind of where they're at, right? Which I would say the more realistic possibility usually is they chase the market at the end of the year, and that's one of just many reasons you usually get the Santa Claus rally, because fund managers are usually chasing those returns in the year end. They're like, crap, man, I need to get somewhat close to this S&P, so we need to pump this market. All right, next one to get into, the market is prematurely pricing in rate cuts. I want to hear what these folks have to say in regards to this one.
Hey, there's Taiwan semi-news we're going to get to, the dollar index, 9th straight weekly gain. You put it all in and you mix it up. What do you take out?
I think we were kind of overdue for this. Listen, in the month of September, we have not yet had a 1% move on any given day. We're sharply unchanged. So today, when you have Treasury yields, which are stubbornly high, near 60...
What does that mean when you're not getting even like a 1% move in the market? That basically means that the market has no conviction either way. It has no conviction that we're going bullish over the next few months, no really conviction that we're going down. It's just in no man's land. And so the market opens each day and, it's not that exciting. There's not some, wow, market's shot to the moon today or spiked down in a massive way. It's just, things are floundering around. Stock prices are moving up a little bit, down a little bit, but there's no dramatic moves in terms of the indexes.
Year highs, in fact. When you see the price of oil go to $91.15, when you understand that today is not just a triple witching day, but a quadruple witching day.
The options expiration is going to be interesting at the close.
The statistics behind that, Scott, they're not good. If you go back to 1990, I think Bob gave this statistic, but you go back to 1990, the week following a September triple witching, 79% of the time the market's down, 1% on average is the loss. So bring it all together, stir it up in the pot. Yeah. It doesn't make for a good near-term formation for the market.
All that said, Jenny Harrington, the major averages for September, leading into September.
And by the way, for us long-term investors, I think it's important everybody understands this because he's talking about, 79% of the time, this means the following week you get 1% down in the market, right? For us long-term investors, who cares? Literally, does it even matter? 1%, it's irrelevant to us, right? Sweet, we'll buy some stocks for cheaper, right? The thing that's important to understand and why it's so much of a bigger deal is remember how much of the market is made up of traders and trading activity, especially on Wall Street, right? And so for these folks, a 1% move is massive because remember, they're trying to catch these little breadcrumbs here and there, right? And so a 1% move is massive for these folks. Absolutely epically massive. For us long-term investors, like 1% put us to sleep. For these traders, I'm just telling you, like 1% is huge for these folks because they're so trying to catch these little breadcrumbs here and there, right? Us long-term investors, we're worried about our stocks going up 50%, 100%, 200% over the coming years. These folks are worried about how do I catch this 0.2% gain on this stock.
Like, oh man, historically bad month for stocks. S&P's down 1% in September. Dow's flat. S&P's only 3% from its 52-week high. So we talked yesterday about the resiliency of the market. Even Ken Griffin, who was interviewed yesterday, was sort of surprised we've been able to get to where we are, even in the face of all this other stuff. So what does it mean? Where do we go from here?
Well, I think with respect to thinking like, oh, September's bad, as we've talked about with the whole, like, is there going to be a recession? The more something's anticipated, the less likely it's going to actually be bad. I am firmly in the camp that I've been in for the last 2 years really now, which is we are range bound. And when I say range bound, I'm thinking of range bound at the S&P level. And that's something that you pushed me on a lot, saying like, okay, but what about beneath the surface? What about the other 493 companies? So I think at the S&P level that we're range bound, but I think if you look beneath the surface, what we've had rolling recessions, and you know what the opposite of rolling recessions is? Rolling recoveries. And so you use the word, Scott, cross currents. There are so many cross currents beneath that surface, and those cross currents create opportunity. So when you say, where do we go from here? I don't think you buy the market, but you can buy interesting things. And so in this tricky market that might be range bound, that might be kind of flat, I think you need to look for companies that have either unique growth characteristics that aren't dependent on the broader economy, that aren't dependent on the industry, but like unique to themselves. So in our portfolio, in our growth portfolio, that would be like Cisco Systems and United Rentals, or things that have...
Before she gets into more stocks that she thinks are buys here, I think this is very important. Everybody understands this, okay? This is why many folks that are experts, and I'm talking about real experts like Stanley Druckenmiller, right? And folks that have phenomenal returns over time and the most educated individuals in the world are basically, talking about a situation where the market doesn't move much in this entire decade, right? And so it really gets into, this is a stock picker's market now at this point in time, right? If you're just buying index funds, you're going to be screwed. Let's just put it that way. You've been screwed. Like the market hasn't done anything for really the last couple of years now at this point in time. Imagine a scenario now where let's say we actually have a recession in 24. Let's imagine a scenario where the indexes all go down, right? Oh my gosh. And then you're worried about trying to recover. Then all of a sudden you're pushing out 3 years, 4 years, 5 years. You still haven't made any money, right? 6 years, 7 years. Now you're hoping to get back to where you used to be, right? This is where it's, let's just call it tough sledding, from kind of that standpoint. Meanwhile, there's going to be companies that get extremely undervalued or overvalued at particular times, and you're able to take advantage of those opportunities in the market, right? And pick up on the greatest companies in the world that are going to do far better than the indexes in general, right? So yeah, we're getting into a very divergent market. It's very range bound. And we'll see if it ever breaks out. The only way it's going to break out to the upside, you have to be insanely bullish that inflation's coming down massive and the economy is going to be absolutely stellar and earnings are going to be stellar in terms of a major uptick for the overall indexes. Meanwhile, there can be tons of stocks that perform tremendous. Like look at how many companies this year are up 50%, 100%, 150%, 200%. It could tell you it's not the indexes that are up that much. The indexes are, having a decent year, but it's really about certain stocks that are performing tremendously well.
Valuation distortions.
Yeah, but I look at your move. Sorry to interrupt you, you're doing more trimming than buying, right? You trimmed Uber and XPO.
Right, but we're fully invested.
Yeah, I know, but you're looking for opportunities perhaps to take some off the table of big winners.
Oh, for sure. Okay, fair enough.
Rather than looking to buy the market, even though you say you got to buy this, that, and the other thing. I see somebody who's trimming some winners.
Okay, but so we trimmed 2 winners, right? And we trimmed them simply because they'd grown to like large portfolio sizes and they've had really good returns and the valuations are a smidge stretch, but not enough to make us uncomfortable. And we took some of that cash and we repurposed it and added it to Ventas, which is a company that we added back in June. Ventas is a healthcare REIT. It's really undervalued. That one actually falls into that category of unique growth prospects. So as people have returned to skilled nursing homes, retirement communities, they actually really have a tailwind of rental increases ahead of them. So we've taken...
Yeah, so I was like, a REIT? She wants to be in a REIT. That's interesting. But if this is a REIT that is more in the like nursing homes, elderly care, things like that, I can see that doing well over the coming years, obviously with the baby boomer generation certainly aging and that becoming a bigger and bigger segment Yeah, I actually like that play.
We've taken money off of stretched valuations, I'd say, and again, not a negative to the company, just portfolio management, and added it to where we know there's unique growth perspective.
So, Kevin Simpson, speaking of moves, you're a buyer of some things. You bought more UPS, you bought more Walmart. You know, I saw that sentiment number today, which was a big miss. 67.7 versus 69.2 was the estimate. I'm wondering if we're, in some respects, at an inflection point for the consumer, and if that plays anything into your buying.
Yeah, UPS. Do I like UPS? Would I be a buyer of UPS stock here or not? The answer to that is, I gotta say, I'm probably not too big of a fan of buying UPS stock right now, to be quite honest, okay? The valuation's pretty fair, I would say that. I don't think the valuation's certainly not undervalued. I also don't think it's some crazy overvalued stock. I think it's a fair valuation. So it's not like you're buying necessarily an undervalued stock. Second component is you got obviously all those wage increases going on that just are about to go through. So I think that's going to negatively affect UPS. On top of that, you have to be convinced the economy is going to be great for UPS to really thrive, right? If the economy gets hit in any significant way in 24 or in future years, that's certainly going to put a damper on UPS. And then the fourth part is they're really competing with Amazon. And Amazon's just getting more and more competitive in this space over time. So I don't know. I think UPS is not the most attractive buy in the world. Let's just put it that way.
Or Walmart.
I don't know that the inflection point's the reason for it. I think that's the thesis moving forward. If we get some economic slowdown, that the consumer benefits, Walmart benefits from the consumer dropping down. But I still think the bull narrative holds. You know, it might be holding by a string for most of the summer. And as we head into the fall, it's September, it's October, we get a little bit nervous. But the things that have held the market up so far, the assumptions that inflation's coming down, we're experiencing a soft landing, the Fed's done or close to being done, all those themes are still in place, but they become more precarious. And where I think the market might be getting it wrong, Scott, is I think we might be prematurely pricing in the rate cuts. I'm not of the camp that we're going to see them in the beginning of next year. I have a lot of reasons why, but I think we're probably looking a year out before we can really have that conversation.
But I mean, the most interesting thing you just said to me was that the bull narrative holds.
Yeah.
You think the trend is still intact?
Yeah, I do.
Why?
I just think that all of those things are still working, and until one of them isn't, then we're in trouble. So CPI was a little bit hotter, PPI was a little bit hotter, retail sales a little bit stronger, but nothing enough to move the Fed off the narrative next week. Now we'll look at the dot plots. That'll be fun if any of us care what they say. But what's problematic is that November's still going to be on the table. And that presents a problem for the higher for longer scenario to take place. Whether they raise rates or not in November, it just pushes the rate cuts back.
Interesting. Yeah. We'll see. Okay. Liz Young, SoFi. Let's hear what she has to say about the consumer being screwed.
At SoFi, and that was the first thing I'd ask you was the response, the 350-point move that we saw. We had the CPI, which didn't allay anyone's fears, really. The PPI didn't either. And then the ECB raised, and yet all that taken into account ended up 350 points higher. Why, Liz? What did the market sniff out?
Well, I think there's a couple things going on. I mean, we're obviously closer to the end of this hiking cycle than to the beginning. So the market is seeing that as a positive sign. And actually, since last night, even the probability of a Fed hike has changed a little bit. But last night it was 2.8% for next week. Now it's up to 3.8%. So the market does not expect any surprises out of Jerome Powell next week. And I think we're pricing in the increased likelihood or the increased expectation that we pulled this off and that there would be a soft landing and that we can sustain higher inflation without breaking the labor market. I think some of the negatives that you look at with this CPI report and everything that came out is, number one, the measurements that we have. So we talk about core and removing food and energy from the equation, and then this super core, which also removes shelter from the equation. It starts to sound like, well, if you just take out everything that might be a problem, the number will look okay. But the reality is that consumers cannot remove all of those items from their daily lives. So it continues to take a bite out of that, and I would expect it to start showing up in spending as the month.
Yeah, but to be fair, the bears on the other side are now all of a sudden just trying to look at, just the headline regular CPI number and try to avoid all the ones that are the more volatile ones. So I've seen the bulls play with it both sides. I've seen bears now play with it both sides. And it's really like, which way do you want to look at it? Because the bulls are saying like the real reason CPI is obviously in an elevated place right now is because of gas prices and because what's happened with oil, right?
drag on.
We haven't seen oil at 90 for a while, and it doesn't mean it's not going to 100 either, Liz. And I know California, good old California, unbelievable, but $5.52 a gallon. That a lot of people, that becomes a pretty large part of their budget in this environment where we still have inflation. For what we use, up about 6% off of already much higher levels from the past couple of years. I mean, it's tough.
That's right. It continues to take a bigger bite out. We've got gas prices at a 1-year high, and you've got, even in that CPI report this week, transportation costs up again, airline fares up quite a bit, and taking a bigger bite out. So, and then this auto workers strike probably not going to help any supply issues that we may have on the car side of things. So yes, consumers are facing an uphill battle. And one of the things that I think we celebrate a lot about the inflation reads is that the growth rate has slowed quite a bit, which it has. And I recognize that, down from 9.1% last summer to 3.6% today is a big slowing, but it's still growing. Prices have not.
You know who's the biggest beneficiary of these oil prices going up so substantially, okay? Let me tell you who it is. You might think it's oil companies, okay? No, I'll tell you who the biggest beneficiary of all these oil prices going up so much is. There they are, okay? There they are. Good old Tesla, Tesla. They're the biggest beneficiaries of this. At the end of the day, consumers have been hit now 2 straight years, just at different time periods, really, in regards to very high gas prices, right? And so now the consumer has been hit with these $4 and $5 gas prices 2 straight years. I can just tell you, consumers are going to think much more about an EV for that next vehicle. Because, you know, people, if you just hit them once, they might let it pass. You hit them twice, okay, now it's serious. And that's what's happened 2 straight years. Folks in California paying $5+ a gallon. 2 straight years they've been hit by this, right? Folks in states that usually don't even have very high gas prices have been facing $4+. They faced it last summer. They've been facing it now this summer. And so I'm just telling you, like, people are going to say, why would I buy an internal combustion engine for my next vehicle? Why not buy an EV, okay? And so just remember, like, now this has been ingrained into folks thinking gas prices of $4 or $5. They're definitely going to consider, let's just call it EVs moving in the future, because it's a huge difference, man. When you're paying $2 a gallon versus paying $4 or $5 a gallon, and you got to gas up every single week, and now you're spending an extra $20, $40, $60 a week, depending upon how much fuel your vehicle takes on a weekly basis, yeah, you're going to start saying, maybe an EV sounds good. Imagine all the folks, that work obviously in like the construction industry, or just in any industry where you drive a big truck around, an F-150 or whatever, right? And those folks, you got to drive all over your city all the time, right? And all types of different job sites. You can easily run through $100 to $200 a week in just gas, right? I think a lot of those folks are going to consider an EV truck next time around, rather than these whole, let's gas up and spend $100, $200, $250 a week gassing up. Whew.
So consumers are still having to pay that. And as inflation comes down, what happens is companies don't have as much pricing power. They can't pass it.
Imagine being an Uber driver, Lyft driver, or whatever, right? I'm starting to see more and more Uber drivers or Lyft drivers starting to drive Model 3s or Model Ys around. And the reason being is, guess what? You don't have to pay that $5 a gallon for gas, right? You're driving all around. You're picking up people. You're taking them everywhere. They're probably going to like the Tesla a lot more than any other vehicle you're going to drive them in. And plus, it's going to be way cheaper. It just makes financial sense.
Through. They can't justify it as much anymore. And then you start to see margin compression. So despite the fact that this cycle and all of these effects have taken probably much longer than many, many people expected, you are starting to see some of that. And I would expect it to accelerate into the end of the year and into next year as we see margins come down even further.
I don't know whether Hollywood can slow growth in the United States, but certainly a protracted Big Three strike could have an effect on the economy and on GDP. I don't know whether that's positive for the Fed. They don't have to do as much. But my concern, Liz, is that we never get a recession when everyone's predicting one. So people started predicting one. And now no one's predicting one. I saw Jeff Gundlach say, definitely next year. This makes me think maybe it could be the calm before the storm. Haven't enough things been sort of added on to where we do get a slowdown at some point? We start to see the lag effect of all the Fed hikes?
Yeah, well, the reality is there's a lot of chatter out there about this time being different, and because it's taken so long and we haven't spotted this recession that everybody's worried about, that maybe it just will never come. But if you look at the time between when this hiking cycle started, we're now in the 17th to 18th month of that. If you look at the time after the yield curve inverted at the 2s, 10s in a decided fashion and stayed inverted, we're 14 to 15 months into that. This is exactly the time when you start to see some of those issues rear their ugly heads. And I would expect it to start to show up in things like credit deterioration. And you mentioned the ECB before. The ECB has had lower real rates than the other major central banks. So them raising and getting more restrictive isn't necessarily a bad thing. But if you compare that with what's happened with the Bank of England being more restrictive than the other major central banks, they're also experiencing more insolvencies than other economies. So there are natural effects that occur as you tighten policy and as you restrict capital in the economy. And I think the Fed is going to get what they want. They're going to restrict capital enough to bring inflation down. That never really happens without some collateral damage. We're just not sure how much and when it'll actually show up.
Yeah, so when we talk about Fed lags, it's basically a viewpoint of how long does it take for the Fed to either raise rates and it crashes the economy eventually, or lower rates substantially and it starts to help out the economy? Because there's some sort of lag period in there, right? It could be months, it could be years. What I found over time studying this is usually 1 to 3 years is what you're looking at until the Fed lags really catch up and start kicking in a major significant way. Now, what is my personal opinion about when do the Fed lags catch up? My personal opinion is 2024, at some point in time, the Fed lags will really start catching up with us and it will start to damage the economy heavily. We haven't really seen the Fed lags really hit in a major way yet. I believe it's likely coming in 2024 at some point in time. It is potential that it might not come until 2025. And so that's an important thing. And that's why, I would be very scared to go all out of the market or try to, bet that everything's going to crash or something like that. I just want to be strategically hedged in a proper way, because at the end of the day, folks, the Fed lags might not catch up. I believe they're going to catch up in 24, but they might not. Okay, and so that's just important to kind of keep in mind there. Alrighty, last video to react to here and kind of share my perspective on. The bear case for oil is the economy and a serious recession. Let's hear what happens here.
The Energy CEO, Chris Wright. Chris, good to have you on. You do buy barrels of oil. You produce barrels of oil. Most of our audience obviously just buys the end product. Are you surprised by this 30? I know you're bullish, but are you shocked by the magnitude of this bull run the last couple of months, and what do you think is exactly behind it?
Certainly the speed at which it happened, Brian, is fast, but supply and demand always works, and this is the direction we're headed. If we're at record demand for oil right now, record demand for natural gas ever, and we've got constraints on supply, that's going to lead to high prices. We were here a year ago, right? And then we drained half of the strategic petroleum reserve, and that put downward prices on gasoline pressure. That put downward prices on oil pressure, but we can't drain it twice. That lever's not there anymore.
Yeah, you've got a strategic oil reserve for the United States. The thought process is that United States has to fill that baby back up. And so that's kind of going to be great for oil price in terms of it going higher in the short term.
Cuts by the Saudis and Russians, 1 million barrels by the Saudis through the end of the year. You've got the Strategic Petroleum Reserve in the United States here at 40-year lows. By the way, thank goodness the Gulf of Mexico did not have a major hurricane for 2 years in a row. We just got blessed and lucky by Mother Nature there, at least as far as that goes. Is there a bear case, however, for oil? Because every time we go up, we seem to go back down. If you had to make the bear case, we're going back to 70, what would it be?
The bear case.
You've got to be flipping my flapjacks. The bear case is oil goes back to 70? No, the bear case for oil is it goes to 35.
The economy. Look, oil demand grows when people's lives are getting better and the economy is growing, not just in the U.S., but all around the world. So if we have a serious recession and a pullback in demand, not just in the U.S. and globally, that will push the price of oil and gasoline and all commodities down. So there's a real possibility of that. Look, the fast rise in oil prices is because this year, after this SPR drains were over, what the administration did was sort of look the other way, and Iranian oil exports have surged. Venezuelan oil exports have grown. So we've had a lot of oil from two pariah nations that grew the supply. That kept this downward pressure of price on oil, and you saw the lower prices in the summer. And I think the Saudis thought, hey, we're not going to take that. And heck, they're closer to Russia today than they are to the U.S. So they offset that growth in Iranian and Venezuelan production by cutting their own production. But as you just said, they cut it by a little over 1 million barrels a day. That's just one year's.
This is what you do for a living. Quickly, I'm sorry, Taylor, I got to ask this one final up question. Taylor's in my ear to say, move on. Here's the thing. When do we get back to 13 million barrels a day? We hit that in November of 2019. But here's the troubling thing. The rig counts went up last week. I get it. But overall, Chris, they're down. Why aren't U.S. producers producing or drilling for more oil given the price?
Well, the simple reason is the publics are going to stick to their plan no matter what. They're trying to get investor interest in their businesses. Where the incremental production always comes from is private companies. And today, less banks are willing to lend, less private capital is going in there. With all these making it harder to invest in oil and gas, we've just got less animal spirits from the private companies. But yes, we'll get to 13 million barrels a day production, but we probably won't grow production fast enough to push down prices enough to be politically popular.
Exactly, because why would you start producing a ton more oil when it's clear as day the U.S. government and really governments around the world don't want oil long term. They just don't. Everybody's trying to transition, and they have all these massive stimulus packages in relation to kind of helping transition to sustainable energy. Like, why would you invest a bunch of money when your industries, they want to eliminate it over the next 5-10 years? Like, that just doesn't make financial sense at the end of the day, because you need to get it would be like if the government was trying to eliminate Walmart, and would you think Walmart would build any new stores if the government was trying to eliminate Walmart? No, of course not, because they need to get a long-term, return on that investment of building a store and then having capital come into that store for years and years and years, right? So same exact thing when it comes to oil well. So, but at the end of the day, I don't think this makes any sense, okay? Because I hear these bears. They're bearish on the economy. They're bearish on what we're going to have moving forward in all those sorts of things. But yet they're bullish on oil. It just doesn't make sense, okay? This is happening prior to the great financial crisis. Oil went to, it was like $140 a barrel at the peak. It was insane, right? And then you had obviously the great financial crisis, and oil dropped to actually not under $30, but it was in the low $30 range. Oil dropped to in that sort of situation, right? So at the end of the day, you can't be bullish on oil and bearish on the economy. It's just, you can't be that. You either have to be bullish on oil and bullish on the economy, or bearish on oil and bearish on the economy. It's really one of those two scenarios, okay? Appreciate everybody joining me as always. Thanks so much for being here, folks. Thank you for being subscribed to the channel. Appreciate y'all as always. If you're looking to apply to join my private group, check out the pinned comment down there. Fill out an application. We see if you're a good fit. Join us in there. Much love and have a great day.